Welcome back to Financial Focus Radio. Thanks for joining us on this chilly weekend here in the Pacific Northwest. My name's Tyler Simones. That guy over there is Josh Fenili. We are partners at Northwest Quadrant Wealth Management. If you would like to take up us on a free retirement review, one of us will give you an hour of our time to talk about anything in your financial life. Call our office to get that scheduled, 800-743-0988, or go to our website, northwestquadrantwealth.com, and send us an email. So I was looking at doing a little reading on that internet thing about your Ducks football team. Mm-hmm. Man, you're right. They have quite a few guys that, I don't blame them because they're going to save for the draft, but a lot of their talent is not going to be out there this fall.
I know, it's depleted. We'll see. The expectations are high.
Well, in the Pac-12, they should be high, right? I think Arizona is supposed to be good. Or Arizona State, is supposed to be good.
USC will be good.
Yeah. So it'll be interesting. I'm just glad they get to play because those kids work their butts off.
Yeah.
This comes from the Internal Revenue Source or Revenue Service. The top marginal tax rate used in payment of federal income taxes in 2020 is 37%. The top marginal tax rate was 70% in 1979, 77% in 1969, and 91% in 1963. I bring that up because, everybody wants to talk about the presidential election and tax rates going higher in your state or whatever. I don't like paying taxes any more than anybody else. And quite frankly, I wonder why we're even paying taxes because the government's spending money like drunken sailors and not figuring out ways to pay for it. That being said, everybody wants to talk about, we get calls from clients or prospective clients to talk about Biden getting elected and him instituting communism or socialism. But let's say he raised taxes by 10%, and I don't think he's going to do that, but let's say he did. It would still be way, way, way lower than tax rates have been in this country. And I bring it up because the great thing about this country is that we figure out a way to make it work and our companies to grow no matter what tax rates are. So I will remind people in those periods, in the 60s, we had a raging bull market in stocks.
The caveat being that there was fairly significant wage growth across at least a couple of those decades.
Yeah, but 91% is a lot different than 37%. And I'm not advocating for higher. Raising taxes. We don't have a revenue problem in this country. We have a spending problem, and that's been true most of our existence, especially lately. But don't fret. It's not going to cause Costco to stop growing and businesses to stop growing if tax rates go up. And I'm not saying this from a political standpoint. I'm saying this as an investor. So don't come at me because you think I want tax rates to go up. I don't. I'm just trying to be cognizant of if tax rates increase, it doesn't mean the stock market is going to collapse like a lot of you want to think that to be true. All right, let's kick off our shame of the week. And the shame of the week this week we've done in the past, I want to be clear to people that I am not knocking ESG investing. And so, Josh, explain to people what ESG investing is. And real quick before you do that, I want to mention what I am knocking here is the relentless marketing by financial advisors and the asset management business, so mutual fund companies, asset managers, and financial advisors, to be ESG, environmental, social, and governance investing specialists. Like we have the best ESG products, or we are a specialist as a financial advisor. I am attacking that, the marketing of that, not the actual idea of the kind of investing we're talking about. So explain what ESG is first. As
you intimated, ESG investing is just allocating capital according to some environmental, social, or governance concern. It's all of the rage in 2020. Fund flows for ESG in April. It's actually the only area of active management where you're seeing positive fund flows. And so, of course, asset managers love it. It's about a little over $1 trillion invested with the ESG consideration, but more than half of new money has some sort of ESG tint to it. And, the belief of ESG managers or the people that push it is you're allocating capital according to your beliefs, and whether that's, in broader ESG indexes, which exclude, say, gun manufacturers or oil companies, it's or as it relates specifically to governance,
but real quick, there's exclusionary type of ESG investing where they exclude things, and then there's best in class. So some ESG might have oil in there because they are the best in class oil company as it relates to the environment, but they're still oil companies. Where others, and the ESG originally started, and it's been around forever. It's been around since the 30s.
For a long time.
But, like the Catholic nuns had funds for this, and Washington Mutual and American funds had, we're going to exclude alcohol and tobacco. So it's been around a long time. So originally it started as exclusionary things, and then it became about best in class. And there's all sorts of different Morningstar data, different data providers provide so-called ESG scores for specific stocks, and many of the indexes that these, if you're indexing in the ESG space, they're based off of these criteria that are created by the index providers. So here's Josh and I are all for investment dollars creating change in a positive way, whether it be environmental, whether it be social and governance, all of the things that, you want a capitalistic society to do. You want investment dollars to create change. That is a absolute positive thing, and we are 100% behind that. What the shame for us is the marketing of these more expensive products to you, the retail investor, thinking you're getting something you're probably not. So if you look at typical ESG funds, they're loaded with technology companies. So and maybe governance is an important thing to you, or having some morality is important to you. But Facebook is in a lot of these. Google is in a lot of these. And if you knew what these companies,
tad bit ironic,
what these companies are doing to society in general, you would have a hard time thinking about them as an ESG company.
It's essentially just resulting in, in 2020, ESG has outperformed X energy, essentially.
Yeah, because it's eliminated energy.
And which, the worst performing sector in the S&P. But, when you think about from a sector perspective, what it does is it just sort of concentrates primarily in technology.
But then there's even things like there's a ticker SHE, where there has to be at least one woman of power or in the board of directors of the company. But a lot of the companies in this index, they literally have one woman on their board of directors, which is great, but it's not like they're making big change. It might just so happen that she might be the most qualified person.
And the data that they're using to actually create these indices, they're doing functionally the same thing that they do for simple cap-weighted market indices, but they're charging you this absurd additional multiple and fees. So ultimately, it's just a ruse. The argument that we usually make is just in terms of your individual purchasing decisions, that's your biggest ability.
When you spend money out in the environment,
that's your biggest ability to affect change. And we talk about it ad nauseum, but the oil industry is a great example. Many energy companies are the biggest investors in alternative fuels,
especially the European BP. All the my issue isn't with the investing dollars based on your beliefs. My issue is the marketing of you thinking you're getting something that you're really not and paying higher fees. And so we have clients all the time, and we don't try to dissuade them from doing it. We just say, look, you're not really getting what you think you're getting, and you're paying higher fees to do it. And so it's just investor beware. And the shame is on the asset management business and financial advisors trying to create another trap to get you to invest with them when you're not really getting what you think you're getting, and that's why it's the shame of the week this week. All right, if you want to be part of the show, give us a call, 877-670-7117, or go to our website, financialfocusradio.com. When we come back, it's Financial Focus University. We're going to talk about 529 plans, so stick around.
Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Northwest Quadrant Wealth Management, a registered investment advisor and separate entity from LPL Financial.